Hey guys, welcome to the channel, the place where traders of all levels learn how to master Forex, sharpen their mindset, and build the confidence to trade like a pro. If you're ready to cut through the noise and discover what really works, you're in the right place. Let's get started. Have you ever thought about how money itself gets traded? Not stocks or gold, but actual currencies, like the dollar, the euro, the yen. It almost sounds surreal, doesn't it? Yet every single day, trillions of dollars are moving across the world in this giant decentralized market called Forex. Maybe you've heard stories of people making a living or even a fortune by trading currencies from their laptop. But maybe you've also heard the warnings. It's risky, it's complicated, you can lose everything. So which is it, really? Today, I want to walk you step by step through what Forex trading is all about, how it works, and why understanding both the mechanics and the psychology is absolutely critical if you want any shot at long-term success. Let's start right at the beginning with the basics, because I think too many channels skip over the fundamentals and jump straight into charts and strategies. Forex, which stands for foreign exchange, is simply the global marketplace where you exchange one currency for another. You've actually participated in Forex if you've ever traveled abroad and had to convert your money. That little slip of paper the airport exchange counter gives you, that's a real-life example of trading currency, on a micro scale. But in the online trading world, you're not just swapping $100 into euros for a vacation. You're speculating on whether the price of one currency relative to another will go up or down. And trust me, it's a lot more exciting than that airport counter. What makes Forex especially interesting is that it doesn't have a central exchange like the New York Stock Exchange. Instead, it's an over-the-counter market, meaning trading happens directly between banks, brokers, institutions, and individual traders all over the world. Because of this, Forex is always on the move. If you're in the US, you can start trading on Sunday evening and keep going all the way to Friday afternoon. The market flows from Sydney to Tokyo to London and finally to New York, creating almost constant price movement. This non-stop action is a big reason why people are drawn to Forex. You don't have to wait for the market to open in the morning. You can trade before or after your regular job if you want to. But of course, this constant availability can also tempt traders to overtrade or become glued to the screen. I've been there, staring at the charts at 3 a.m. thinking I'd spot some magic pattern no one else could see. Another thing that confuses beginners is how currencies are quoted in pairs. Whenever you look at a Forex quote, you'll see two currencies listed together, like Euro, US dollar, or GBP, JPY. The first currency you see, called the base currency, is the one you are buying or selling. The second one, the quote currency, is what you're using to measure its value. Let's use Euro, US dollar as an example. If the price is 1.1000, that means 1 euro is worth 1.10 US dollars. If you believe the euro will increase in value, you would buy this pair. If you think the euro will weaken, you'd sell the pair. And every tiny movement in that number, maybe up to 1.1001 or down to 1.0995, is measured in pips. Pips sound so innocent, don't they? Just 4 little decimal places. But believe me, those little numbers can make your day or ruin your week if you're not careful. Now let's talk about trade size and leverage, because this is where beginners often get into trouble. When you open a trade in Forex, you're choosing a lot size. A standard lot is 100,000 units of the base currency. So if you're trading Euro, US dollar, that's 100,000 euros. Most beginners don't start with standard lots because they require significant capital, so brokers offer mini lots and micro lots. But here's where leverage comes in. Leverage allows you to control a much bigger position than the money you actually have. For example, with 1 to 100 leverage, you could open a position worth $100,000 with just $1,000 of your own money. Sounds incredible, right? Almost too good to be true, and sometimes it is. Because leverage is a double-edged sword. It can magnify your gains, but it can just as easily magnify your losses. I've seen traders blow up entire accounts in a single bad trade because they were over-leveraged. When you open a trade, you're predicting whether the base currency will rise or fall. If your prediction is right, you make money. If it's wrong, you lose. Simple in theory, not always so simple in practice. The amount you gain or lose depends on the number of pips the price moves and the size of your trade. Even a 10-pip move can feel huge if you're trading too big. That's why risk management isn't optional. It's your safety net.
So with all this risk, why do people even bother trading Forex? For one, it's incredibly accessible. You don't need $1 million. You can open an account with a few $100, use a demo to practice, and trade anywhere. There's also unmatched liquidity. Trillions of dollars change hands daily, so it's usually easy to get in and out of positions. And let's be honest, there's a thrill to it. The challenge of trying to outsmart the market can be addictive. But none of that matters if you treat trading like a lottery ticket. That's why you need a clear strategy, risk control, and most importantly, emphatic emotional discipline. This brings us to mindset. I think most people underestimate how much psychology determines their results. You could have the perfect system, but if you can't handle stress, fear, or greed, you'll sabotage yourself. If you're serious about learning Forex, start with a demo account. Practice, test, make mistakes when it doesn't cost real money. Once you feel confident, move to a small live account, something you can afford to lose, to experience the real emotions involved.